Today, folks, am I going to get tired of saying all-time highs? My mind is actually blown against the wall with all the recessionary data people are spewing across the influencer space. Here we sit, another day, another all-time high. Most of us in our chat group are now making more money off our portfolios than we are our personal jobs, our salaried positions, and I am no exception, holding the most boring ETFs. Yes, with some trades in between that did pretty well for the year, but these boring ETFs continue to generate over $500 a month on average, mostly in the S&P 500, and every damn day we log in, we're seeing these three ETFs continually truck toward all-time highs, offering incredible 6-month performance as we get into the final quarter of the year. We're into the third quarter earnings, which I still think are going to offer some pivotal light in this high multiple market that we currently live in. So what I want to do is look at the consumer-focused stocks. We're going to talk about things like Pepsi and Starbucks, Apple and Amazon, and we're going to compare it more on the other spectrum to things like Palantir, Nvidia, Tesla, where I think this bull market and this multiple expansion comes to an end, and so much more in between. So if you are on a path to financial independence, if you damn well want to retire early, like me, like the rest of us, go subscribe, join me on that journey, and hit that like button while you're down there, because we got Pepsi earnings, and Pepsi did jump up even though they lowered guidance, and I think that's just because the company's been relatively beat up as of recently, and I think, you know, it hasn't done well for good reason. I mean, they have been expanding prices to keep up with the lack of volume of shipments, and when we take a look at revenue growth is absolutely almost non-existent here. It's very boring when you look at the 36-week end of basically, you know, net income on an earnings basis of $5.84 versus $5.62 in 2023. There's been absolutely no revenue growth. It has been stalling out pretty much for just over the last 4 quarters, which is something that we haven't really seen. The last time we've seen this kind of red for Pepsi was back in 2014 to 2016 era. So we're seeing a stall out on a company like Pepsi that just can't find growth in a market like this, which again, I've stated has a lot to do with not partnering with influencers and doing a lot of that stuff, because we're still seeing Prime, we're still seeing Lunchables and all these, you know, influencer-like products absolutely blowing up, taking some of that market share. But you could say the same thing for Starbucks, right? Is, you know, coffee's a highly competitive market, and Starbucks is very rarely stalled out. The last time was during the pandemic, but here we are in another period where they are fighting for revenue growth, and these are high-valued consumer discretionary products. Again, you do not need to be buying Pepsi-oriented products. You can focus on vegetables and fruits and other things that you need to eat, not necessarily Doritos and snacks and pop and chips and things of that nature, right? But we can say the same thing about Apple and iPhone products. People are burnt out of high-valued products. I mean, we're still seeing a stall out. Like, this is one of the worst stall outs in Apple's last decade history, like almost 15-year history. This is the greatest stall out period we have experienced. And I don't think that should be understated. It is a true sign of the higher interest rate environment. This is all caused by lack of extra spending material when it comes to loans and margin and all that stuff. But here we sit on the interest rate cut recovery, and we're going to see what it means for the economy, as I still think we're teetering on the edge of too much of a multiple expansion, because these stocks are not cheap. They are very expensive for the lack of growth we're seeing. And Amazon, I think, being the golden child of a true revolutionary industry that has not stopped even on the backdrop of a more recessionary environment. I mean, look at this. We're still seeing double-digit growth, but not like incredible double digits. I mean, ever since we went through the interest rate cycle, I mean, we've seen this company slow down a lot, considering the lowest period of growth they had was a 14 to 15% revenue growth back in 2015, and then again at a 16 in 2019. But here we sit in almost single-digit growth periods, right, which is incredibly unusual for a company like Amazon. So these are the signs that the economy is not as resilient as it once was. But keep in mind, there were some exceptions to these growth periods too, because a lot of that had to do with stimulus. But one thing that fascinates me the most is consumers are still finding ways to spend money on leisure, right? Whether you're going to a Taylor Swift concert, whether you're getting on a cruise like we recently did in May, which was absolutely jaw-dropping, and I wish I owned a little bit of Royal Caribbean, because if you are a shareholder, they actually give you some credits, which is super interesting that they actually contribute shareholders when you're visiting Royal Caribbean, or I'm sure Carnival Cruise does something very similar here. And Carnival Cruise recently posted earnings. They're starting to pop off. Royal Caribbean has crushed it this year, up 60%. When you take a look at the revenue recovery coming out of the pandemic, it has been nothing short of absolutely astounding that the end consumer really wants to get back out and travel. People seem to love travel. Double-digit growth rate travel in the backdrop of a very tough market environment might shine some light on consumers have money to spend. It's just where they're choosing to spend it. Now, the thing that I think has personally been keeping the market up has everything to do with the hype cycle of stocks. Because when I think of hype, when I think of, you know, four-fronted stocks, everyone and their grandmother's talking about, it has to be Palantir, Nvidia, and Tesla. These three hype stocks trade at absolutely absurd valuations for the current growth rate we're getting, and it is highly reliant on future expectations of their underlying businesses and products that they're offering. And all of these sit in relatively different industries. And I want to show you the difference in value versus industry and why Palantir has garnered so much attention and how Nvidia, is starting to pressure back toward all-time highs. And these two companies specifically have a lot to do with business-to-business sales, not consumer sales. Again, we'll talk about that comparable with Tesla. But when I think of companies like Palantir and Nvidia, we'll start with Nvidia. Okay, so Nvidia CEO says the demand for chips are still insane, even on the backdrop of Meta building its own chips, Tesla, Amazon. I don't think there's one big tech company that is now buying from Nvidia that hasn't released their own version of an AI chip to meet the supply demand slump. So here we sit, and the CEO is still saying the demand is off the charts. If this remains true, and these are very cyclical businesses, the company's going to continue to do exceptionally well. I mean, we're talking about absolutely absurd growth rates, but again, these are highly cyclical industries because they're so based off, market trends and when the demand for these products are at their highest. And I mean, we can see that through the crypto crash here coming through 2023 when it started to recover into the AI. I mean, you can see the same thing going into the pandemic. There's just ebb and flow. But right now, that flow is coming purely from business to business, not me or you. Me and you are not driving Palantir or Nvidia's growth. We are the smallest drop in the bucket in comparable, right? And the same thing when we're talking about Palantir and why its growth recently took back off is because they've introduced a bunch of new products. They put a lot of money behind R&D to utilize AI in government, especially in the army, and to utilize it in corporate, where they can start using like basically sensitive, very large data sets to help companies make more divisive decisions, especially when it comes to spending, claiming they can save companies millions of dollars instead of having analysts and technical people. You could just use the robots that are slowly taking their jobs, or the AI tools, of course. And we can see that basically, if you read into this, their commercial revenue soared by 33% compared to last year's quarter. Additionally, the segment annual contract value, or ACV, grew by 44% year over year. The high demand for Palantir's AIP solutions from new and existing clients sets the stage for future growth. So everyone's suspecting that this is going to continue to accelerate, as we're currently seeing the revenue, which fell off pretty dramatically coming into the interest rate cycle. For a software company to only be growing at 12% was pretty sad when you compare it to the likes of Shopify and Constellation, which I've done in the past. And now we're getting back into that 27% range. But Palantir is priced as though the same reason Nvidia is priced. There's a huge expectation on the forefront that they are in a new growth cycle, and they have to prove this growth cycle to justify it, right? Like, the easy money in Palantir has largely been made. What I'm seeing now is trading action and people, buying into that hype, which leads to excessive overvaluation and frothiness. Again, I don't understand their business well enough to want to take the risk up here. Anyone that took the risk down here has absolutely crushed it. They foresaw something, many didn't. I would just be very cautious with all these companies at the top, right? Which is why I continue to cost average into an S&P index, because I get exposure to all of these. But if they do go out of favor, I'm not at risk of losing my shirt, especially if it becomes a larger position at the scale of growth we've experienced in your portfolio. You should take profits, or at least set stop losses, or protect yourself to the downside with some options, just to be safe, right? Especially if you've gotten some wicked gains, because I've always taken profit when I've made hundreds of percent or 1,000% gainers, and 9 times out of 10 those stocks traded dramatically lower over the coming years than they did to the upside. But that's not saying that's going to happen to Nvidia or Palantir. Now, Tesla, I think this is the hype stocks of all hype stocks, because it is able to garner a 68 price to earnings multiple during a period where it absolutely has zero growth. It is stalled out dramatically. It is claimed to not be an auto business, but all its money comes from auto, and is now seeing a little bit of growth that is making up for some of the slump in auto sales when it comes to their energy storage and deployment. But basically, everyone is sitting on the edge of their seats as Elon Musk is keeping investors' dreams of Tesla robotaxi alive. And this is either going to be one of the cringiest events, or it's going to take Tesla and revitalize it. And a lot of us do not have high expectations for this. In fact, I was just listening to Dumb Money, and you can take a listen, because these clips and these points are funny nonetheless.
Anyway, so it's like, I want him to do his best, and I want him to be exciting, but I just know that there's going to be I'm going to be cringing the whole time.
I feel like Tesla would have had a huge pump going into this event if not for him getting sidetracked the last 2 weeks on politics. I mean, he's gone so deep into politics the last couple of weeks that he just seems really scattered right now. He doesn't seem focused on Tesla at
You can
all.
say that. I think you could actually make that exact same claim any week over the past 7 years. Like it's not just it's not like right now you have something to point at, but you have had something to point at every week for the last as long as I can remember us talking about Tesla. We've always been like, yeah, but he's scattered right now, but somehow he's managing to pull it all together.
Okay, but this is bigger. I've never seen him go this deep into politics.
And I have to agree here. I am very sad that Elon, I think he cares less about his businesses these days as much as he cares about politics. He's an egomaniac billionaire. I mean, let's be real. The dude has like a half dozen children that you'll never really see. And, he's not in any major relationship. And I feel like his next major move is getting into politics, which is why he's backing Trump so aggressively and clearly sidelining whatever's been going on with Tesla. He's got to go do a SpaceX event here. Like, there's so much going on around this guy that I just don't feel the same love for Tesla that I did, coming through 2019. I mean, that was the era of a true dream being made. Now Tesla's fighting. They're fighting for their lives, and they're clearly garnishing a lot of support. But they have to maintain this, and their last few events have been, not the most exhilarating for the stock, and it hasn't proven to come into fruition by any extent when it comes to any of their vehicles, really. I mean, Cybertruck's been a slow ramp. It was, years delayed. We don't even have the Roadster. We don't have like any scale up on the semi truck. Self-driving still isn't functional as far as anybody can tell. Their interventions are still far too high from people that are using it that we've watched on this channel that actually use the software every day. So it'll be neat to see what happens. But as I digress here, I really want to point out that if hype comes to fail, and it will, it always does, we are going to see a correction, I think, in these upper value tech stocks if they do not hold. Now, we're not saying they can't hold. I think AI, again, has proven capabilities that has to start value creating. And so long as the market doesn't lose hope as that comes into fruition over the next 1 to 3 years, we can still maintain a high valuation because the S&P 500 still, I like to believe, will go through these cyclical cycles all the time. When we look at the PE history, anytime we get these massive spikes in value based off new tech, it always seems to correct at some point, and we're at a 30 PE right now, which again, anytime we go through these massive volatile spike periods, it tends to pull back. We're not in the dot-com level, we're not like 2008, but we are definitely at upper ends of growth. So we'll see if the S&P can sustain this, but in the meantime, we'll just sit here, keep building out our portfolio and cost averaging. It's fun to get excited here, but it was a lot more exciting buying through 2022 because that's what led to the gains in performance we're currently seeing today. But I'll pass that question off to you. I'd love to know what you think in that comment section below.